The market just bounced 10% in a single day. On paper, that sounds like a comeback story, like maybe the worst is over and we're heading back into safer territory. But hold up, this exact kind of bounce, it's shown up before, and not during bull runs. We've seen it at the tail end of the COVID crash, right after Black Monday in '87, and near the bottom of the 2008 financial meltdown. Every time, it was followed by more pain. That's why today, we're not chasing the hype. We're going to look at one signal that most people completely missed, a signal that might be telling us the fall isn't done. In fact, it could be just getting started. Over the last few weeks, the stock market's been on a roller coaster. After a brutal correction of more than 20%, panic set in. The main trigger? Trump's tariff policy shakeup, a move that rattled global markets and had investors bracing for impact. Then suddenly everything flipped. The S&P 500 snapped back, rising over 10% in a single day, after news broke that tariffs would be paused for 90 days for most countries, except China. Now let's not underestimate that move. A 10% gain in a single trading session is extremely rare. It's only happened a few times in history. At the end of the COVID crash, near the bottom of the 2008 Great Financial Crisis, and after Black Monday in 1987. And here's the uncomfortable truth. In each of those cases, the bounce wasn't the beginning of a recovery. It was a head fake, a short-term relief rally, followed by even more pain. So what does that say about today? Is this recent bounce a sign of strength, or is it just a setup? The kind of rally that pulls people back in right before the next big drop. Here's the part most people miss. Stock market bottoms during recessions don't happen early. They don't show up the moment things start going bad. They happen after unemployment has peaked. That means if the job market starts weakening now, the worst for stocks could still be months away. This isn't fear-mongering, it's pattern recognition. And it's why just pausing tariffs doesn't magically erase the risk. The economic machine is already in motion. Alright, now this is where things get slept on. Everyone's busy watching the headlines, but the real clues? They're buried in the yield curve. This thing is one of the sharpest tools in the macro toolbox. Why? Because it's been eerily good at signaling recessions before they hit, and right now, it's doing something weird. So here's the deal. When the yield curve inverts, meaning short-term interest rates are higher than long-term ones, it's historically been a warning shot, a signal that a recession might be on the way. In 2023, the yield curve was inverted. Not a great sign, but that's not where it ends. The more telling moment is what comes next, the steepening. That's when the curve uninverts and starts climbing back up. And that steepening move usually lines up with the start of an actual recession. It's like the moment the warning alarm goes from blinking red to full siren mode. But here's the twist. Instead of steepening, the yield curve has re-inverted recently. It's gone back down below zero while the S&P 500 has been declining. That's not what you'd expect during a classic recession playbook. Let's look back. In 2008, while the market was crashing, the yield curve steepened. In 2001, same thing. As stocks dropped, the curve steepened. That's textbook. That's what a recession curve looks like. But today, we're not seeing that. The re-inversion suggests the bond market isn't pricing in a labor market collapse, not yet. So what does that mean? Well, it's not a green light to celebrate, but it does complicate the picture. Because if the yield curve isn't steepening, maybe the job market isn't ready to break, not just yet. Still, just because it hasn't snapped doesn't mean we're in the clear. And when mixed with everything else we've covered, this re-inversion might just be the eye of the storm. Now this is the part almost nobody's talking about, but it might be the most important warning sign of all. The gold to silver ratio just spiked, hard. We're talking a 15% jump in just 1 week. And yeah, that sounds technical, but let's break it down. When this ratio climbs fast, it means investors are dumping silver, a risk-on asset, and piling into gold, the ultimate safe haven. It's the market saying, I'm out, play defense. Here's why that matters. This kind of spike happened right before the COVID crash. It showed up ahead of a 20% market drop in 2011 and right before the 50% wipeout during the 2008 financial crisis. See the pattern? Every time the gold to silver ratio does this kind of violent move, it signals deep fear. It's not always about headlines, it's about how traders are shifting behind the scenes. And that's the sign almost everyone missed. While the headlines are focused on tariffs, rallies, and Fed talk, this one ratio quietly lit up like a flare. And historically, it's never been just noise. So even if unemployment hasn't spiked yet, even if the yield curve is re-inverting instead of steepening, this ratio is screaming that something's off. Bottom line, we're not in a full-blown panic phase just yet, but we're also not rushing back into stocks. Because when these red flags start lining up, especially the ones most people ignore, that's usually when the next leg down begins. Now here's the thing, even with that spike in the gold to silver ratio, not everything is pointing to a full-blown collapse. This is where the market starts messing with people's heads. Because right alongside that red flag, there's another narrative playing out, and it's surprisingly optimistic. Let's zoom in. While the gold to silver ratio was screaming risk off, the yield curve, despite being inverted for most of 2023, didn't follow its usual recession pattern. Instead of steepening like it did in past crises, it re-inverted. That might sound like a technicality, but it changes the story. Because in past market crashes, 2008, 2001, the curve steepened as stocks fell. This time, it's doing the opposite. Why does that matter? Because when the yield curve reinverts, it's a sign that the bond market isn't fully pricing in a labor market breakdown yet. It's saying, yeah, we're worried, but we're not in disaster mode. And historically, there have been periods where the curve reinverted, the unemployment rate stayed low, and the economy avoided recession. During those windows, the market actually did pretty well. So that's the paradox. On one side, you've got signs like the gold to silver ratio that have only appeared before major crashes. On the other, you've got bond markets sending a more neutral, even slightly positive signal. And if tariff negotiations go well, that could lay out a decent backdrop for markets and the economy to breathe a little. It's no wonder investors are confused. One chart says risk off, another says maybe we're okay. That's the tension. And when signals start clashing like this, it's usually the moment where things tip one way or the other, hard. Individually, each of these signals could be debated. A bounce in the market? Sure, it happens. A reinverted yield curve? Odd, but maybe not catastrophic. A spike in gold to silver? Could be a fluke. But when all these signs hit at the same time, that's not coincidence. That's convergence. Let's line them up. A historic 10% market bounce, just like what we saw right before past major crashes. Unemployment's still low, but with a recessionary setup already in motion. A yield curve that's moving against the usual recession script, and a gold to silver ratio screaming risk off in the background. This isn't about calling a top or trying to predict the exact day things fall apart. It's about understanding where we are in the cycle and how these are the moments where investors get blindsided because everything seems okay on the surface. And that's what makes this so dangerous. Everyone's looking at the obvious stuff. Headlines, policy news, daily market moves. But the deeper indicators, the ones that don't make the front page, they're telling a very different story. The fall might not happen today or tomorrow, but the signs are there. They're piling up. And the next leg down might have already started, quietly. So here's where we are. The market bounced big, but the deeper signals aren't buying it. Recession pressures are building. The yield curve's throwing off strange signals. And the gold to silver ratio, flashing a warning we've only seen before major crashes. This doesn't mean you should panic, but it does mean you should pay attention, because these aren't just technical quirks. These are the signs that history shows always show up before the real damage hits. Everyone's focused on the surface, we're watching the cracks underneath. Stay sharp, stay patient, and most importantly, don't fall for the bounce. If you're watching the signs like we are, don't just scroll past this moment. Hit subscribe so you don't miss the next update, because the market isn't done talking. Thanks for watching.